Let's talk about price action. If you ask me, it is easily one of the most critical elements you will ever encounter when trading with technical analysis. It has this incredible ability to predict whether the market is about to jump or plummet, and whether a trend is gaining real momentum or just losing its steam. From my experience, if you don't truly understand how price action works, the honest truth is that your chances of becoming a successful trader are slim. Let me share with you exactly why that is. Think about most of the indicators out there, even the incredibly popular ones like moving averages, MACD, RSI, or stochastics. Every single one of them is a lagging indicator. When I say lagging, I mean that they rely on past price data just to calculate their output. So sure, an indicator might eventually flash a signal telling you to jump into a trade, but most of the time, the chart has already made its big move before that little signal ever shows up on your screen. This is precisely why mastering price action is such a powerful asset. It cuts through the noise and helps you make critical decisions in real time. There is no delay, no annoying lag, just pure, in-the-moment trading right here. I want to reveal 4 price action secrets that are going to help you trade much more successfully and ultimately transform you into a better trader. The very first price action secret centers around the humble candlestick. When most people look at a candlestick, their eyes instantly go to the wicks. Now, while those wicks are certainly important, the real story is often told by the body of the candle itself. Take a close look at this specific candle. Its characteristics are incredibly distinct. It is a massive green body without any wicks on either end. Whenever a candle like this forms, it tells us that buyers found this particular price so incredibly attractive that they stepped in and started buying in massive quantities. The buying pressure became so overwhelming that the price just surged upward, while the selling pressure was so utterly weak that the sellers couldn't even put up a fight. That is the exact reason why this specific candle managed to achieve such a strong close. Whenever you spot a green candle like this, it is an extremely bullish sign, and it also serves as a fantastic marker for a potential support or resistance level. One of the most valuable lessons I've learned in trading is that the past has a funny way of predicting the future, and that is exactly what plays out here. We spot our big green candle with the massive body and no wicks, so we draw a support line right at its base because we know buyers fell in love with the price at this exact level. The price meanders sideways for a little while, coasting along until it eventually dips back down and hits our level again. That brings me to the second secret, which is a concept known as mean reversion. Mean reversion is really just a simple, fancy way of saying that the price will always find a way to return to its average. Imagine we are looking at a chart with a whole bunch of erratic price movements. It looks chaotic, but if we overlay a 50-day moving average across the screen, a clear trend suddenly emerges. Whenever the price takes a deep dive way below that moving average line, the price makes a sudden dip downward, pulling far away from the moving average. This would be an ideal time to buy because we understand that mean reversion is at play, and the price will likely journey back up to the average. And as you can see, that is exactly what it does. The third price action secret is all about momentum. Momentum is a massive piece of the trading puzzle, and it can give you some incredible clues as to whether a chart is gearing up to turn bullish or bearish. At its core, momentum is simply the velocity or the rate at which a price moves. Because of this, we can accurately predict that a price is going to climb if we can see that the chart is actively building up speed. On this part of the chart, you can see the price moving upward. Then, it undergoes a minor pullback, and suddenly, the chart fires off with a sharp, aggressive upward surge. This tells us that the chart itself is gaining momentum. The initial upward climb was much more gradual compared to this explosive second move, meaning a wave of new buyers entered the market, found their strength, and accelerated the pace. The chart gained massive momentum, and you can see what follows next. The price makes a shallow downward pullback, builds its energy. Now let's talk about the fourth and final secret, which deals with pullbacks. This is an extraordinarily powerful concept to master. Whenever a chart journeys up or down, it never moves in a perfectly straight line. Instead, it moves in waves, creating pullbacks. These pullbacks are simply the minor price corrections that give charts their characteristic jagged look. In reality, a pullback is just a visual sign that traders are actively banking their profits. Because of that, the actual size and depth of a pullback can give us a mountain of information regarding what the chart is planning to do next. If the chart is locked in a strong uptrend and it undergoes a very weak, shallow downward pullback, that tells you that very few traders are actually exiting their positions. That lack of selling usually means a powerful upward surge is coming right around the corner. On the flip side, if you see a deeply aggressive, strong pullback, it means a flood of traders are jumping ship and closing their trades. When that happens, the odds shift, and the price will likely start grinding sideways. At this point, you might be wondering how on earth you are supposed to look at a chart and distinguish a weak pullback from a strong one. Well, let me show you the trick. To solve this puzzle, we are going to employ the Fibonacci retracement tool. It is the perfect instrument for measuring whether a correction is genuinely weak or strong. To get it set up, just open up whatever charting platform you happen to use, navigate over to the Tools sidebar, and select the Fibonacci option. To keep things beautifully simple, we are going to delete a bunch of those levels so the tool becomes much easier to read and interpret. All you need to do is click and drop the Fibonacci tool anywhere on your screen, select it, and open up the settings menu. From there, go ahead and uncheck every single level except for these specific ones: 0, 0.382, 0.5, 0.618, and 1. The way we decipher whether a pullback is strong or weak comes down to how the price interacts with these remaining lines. Let me walk you through a live example. The very first step is to anchor our lower line precisely on the lowest swing low of the move, and then stretch the upper line all the way up to the highest swing high. For this scenario, let's say we are actively hunting for a long buy trade. We will officially classify a pullback as weak if the price dips but manages to stay above the 0.382 level. If the price slides down and breaches below that 0.382 line, then we are dealing with a strong pullback. And remember what we established earlier: the weaker the pullback, the better the setup. If you look at this example with me, we have stretched our lines from the low straight to the high. We can see the price rallied up, and when it decided to pull back, it only dropped as far as the 0.618 line, staying safely above our critical threshold. That is a textbook weak pullback and an incredibly bullish omen. We execute our entry right here, and as expected, the price immediately resumes its march upward. Now let me flip the coin and show you what a strong pullback looks like. In this next example, we perform the exact same steps, anchoring our points directly to the highest high and the lowest low. This time, we watch the price push upward, but when the correction hits, the price tumbles violently, sliding way down past the 0.382 line. Because it sunk below that marker, we classify this as a highly aggressive, strong pullback. Armed with our secrets, before we conclude, there is one golden rule I need to emphasize. If you try to use any of these price action secrets completely on their own, as an isolated strategy, you probably won't find a very high win rate. However, when you start stacking them together, or better yet, when you pair them up with a few reliable indicators, they transform into an incredibly lethal and powerful trading weapon. By mastering the relationship between candle bodies, averages, market velocity, and measured pullbacks, you can fundamentally shift the odds back into your favor. To prove to you just how devastatingly effective this approach is, when you combine these rules, I want to pull back the curtain on a specific scalping strategy that relies entirely on this very philosophy. Trading with the macro trend, never against it. I've put together a precise indicator combination and a mechanical checklist that has been rigorously back-tested and proven to deliver consistent results. The beautiful thing about this framework is its versatility trend. With that philosophy established, let's break down exactly how this unified strategy operates. Rule number 1, which serves as the vital foundation of the entire system, dictates that we only trade with the prevailing trend. To remove all guesswork, we can objectively determine whether a chart is in a true uptrend or a downtrend using a tool we mentioned earlier. You just need to open up your charting platform, go to the Indicators tab, and search for the EMA, which stands for the Exponential Moving Average. Once it's on your screen, dive into the indicator settings and change the length to 200. This plots a 200-day moving average right across your chart. Personally, I like to color this line red just to make it pop visually, though that part is completely optional. To satisfy this foundational trend rule, we will only consider entering a long trade if the market is trending upward, meaning the current price must be trading completely above that 200-day red line. If the price is drifting anywhere below the 200-day line, the setup is dead to us, and we absolutely will not enter. That is your baseline filter. The price must be above the 200-day line to prove we are trading with the trend. Now that we have rule number 1 locked down, we can move on to the rest of the criteria that must align perfectly before we even think about executing. Rule number 2 introduces the RSI indicator, but we are going to use it with a very specific twist. Head back to your indicators menu and type in RSI divergence, making sure to select that specific variation. To keep our workspace clean and free of unnecessary noise, we are going to modify the settings. As we discussed earlier, most traders use indicators like the RSI to spot overbought or oversold extremes. In this strategy, however, we are magnifying its core function to measure underlying market velocity and momentum. This brings us to rule number 2. We will only enter a trade if the RSI line is actively trading above that central white line. Even if every other rule on our checklist flashes a green light, if that RSI line is lagging below the midpoint, we walk away. The brilliant thing about using this specific, customized RSI indicator is that it automatically tracks divergences for us. As a reminder, divergence occurs when the raw price action and the indicator begin moving in completely opposite directions, such as seeing the price making higher highs on the chart, while the RSI is printing lower highs. This tool is designed to automatically highlight bullish divergence right on your screen when it occurs. It serves as an incredible confirmation signal that a massive bullish move is brewing. That takes us directly to rule number 3, which brings us back to our secret weapon, momentum candles. They are one of the cleanest ways to catch the exact birth of a new trend. The specific momentum pattern we are hunting for here is known as an engulfing candle, where a single price bar completely swallows the entire range of the immediately preceding candle. A true bullish engulfing candle will open at, or even lower than the previous candle's close. Then, an influx of aggressive buying pressure drives the body of the candle upward until it entirely blankets the body of the previous red candle, ultimately closing well above the previous candle's opening price. It is a textbook display of buyers seizing total control. Instead of burning our eyes, those green arrows represent our bullish engulfing candles, and rule number 3 states that we can only execute a trade if a fresh green arrow appears. Let's walk through exactly what a flawless, textbook trade looks like when all these elements come together. First, we verify that the price is trading safely above the 200-day line, confirming the macro trend is pointing up. So far, so good. Next, we glance down to ensure the RSI line is holding above the 50 midpoint, which it is. We don't necessarily need to see a bullish divergence symbol, but if one happens to be resting there, it is a massive bonus that makes the setup even more compelling. Finally, we look for our green arrow. There's an absolute golden rule regarding this entry that I must emphasize. You only enter the trade after the candle containing the green arrow completely closes. Let me repeat that because it is crucial. Only enter after the candle closes. While a candle is actively forming in real time, a green arrow might flash on your screen, but if the price drops before the expiration of that time bar, the arrow can vanish, meaning it failed to mature into a true engulfing candle. Once that candle closes and the green arrow is officially locked onto the history of the chart, you open your position. For the risk management side of this specific strategy, we will set our stop loss at exactly 2 times the total length of that entry candle. We then project our take profit target out to achieve a precise 2-to-1 reward to risk ratio. It is genuinely that systematic. Once the parameters are set, you simply let the market play out, and the price marches straight up and hits our target. Let's look at one more example to really solidify the process. First, We scan the chart and confirm the asset is trading comfortably above the 200-day moving average line. Next, we look down and verify the RSI is holding above the 50 line. In this instance, we also notice the indicator has flagged a bullish divergence. Again, this isn't an absolute requirement, but it heavily stacks the probabilities of a winning trade in our favor. Then, right on cue, a candle prints with a green arrow resting underneath it, signaling a confirmed bullish engulfing bar. We patiently wait for that specific time bar to close. The moment it closes, we enter the market. We measure the engulfing candle, set our stop loss at twice its length, place our take profit order at a clean 2x profit ratio, and let the trade breathe. The price gathers strength, climbs steadily, hits our take profit target, and we exit the market with a clean win. This strategy delivers remarkable consistency simply because it refuses to fight the natural momentum of the market. By combining trend direction, momentum filtering, and automated price patterns, you remove the guesswork from your trading. Stick to the rules, trust the back-tested parameters, and let the edge play out over time.